Myself, Shamruta from 3rd BCom, Department of Commerce, Shri Kanika Parameshwari Arts and Science College for Women. Welcome to this small lecture about marginal costing. Basically, marginal costing is one of the techniques of costing like budgetary control and standard costing, but we are going to see about different aspects in marginal costing. Typically speaking, marginal costing is the additional cost of producing an additional unit of product, which is nothing but apart from the ordinary course of production. If there is more demand to a particular product, thus an additional or an extra unit is being produced, then such units of cost of production is named as in marginal costing, and it is also the replicate of variable costing. Before going into the theoretical part, we need to know some terms in marginal costing. So I would like to take you through an example so that the concept will be understandable. Now, for instance, there is a person called A. He is a wholesale dealer. A person called B goes to A to give a bulk order. Say, let the product be a pen. Further, the B receives the pen at each rupees 10. Now, B is reselling those pen at each at rupees 20. Thus, he gets a profit of rupees 10. Now, if B wants to do this as a business, then he needs a place to buy and sell the commodities, which is nothing but a shop. Thus, he needs a rental place. So, let his shop rent be rupees 5,000 per month. Will the rent be affordable to him? To afford this, how much pen he should sell to pay his rent? He needs to sell 500 pens at rupees 10 each so that he will get 5,000, or he could do 250, or he could sell 250 pens at each rupees 20 so that he will get 5,000, or whatever variations it may be, but he should be ready to afford rupees 5,000 per month for his rental place. And as he is running his business, suddenly there is a high demand in market for 700 pens. Will B continue his business or not? Undoubtedly he does, because it gives a high profit margin. And Mr. B sold 750 pens at rupees each 10, which is 7,500. Therefore, he can pay his rent of rupees 5,000, and the balance 2,500 is his profit. And here in the given example, the fixed cost is his rental place, because it will always remain constant and fixed irrespective of his output. And the variable cost is his expenses which are met to produce such pens. It could be material, labor, or any other direct expenses, and thus it changes according to the quantity of output produced. And total cost is nothing but which is fixed cost plus variable. And we have another term called contribution. It is derived as contribution is equal to sales minus variable cost. The difference between the sales and the marginal cost is named as a contribution. In marginal costing technique, contribution is a very important concept as it is used to find the profitability of the product, process, departments, and divisions. Practically all decisions are based on and oriented towards the contributions. You can derive contribution in two ways. One is selling price minus variable cost. Another one is fixed cost plus profit. So there are two ways to derive contribution, and to derive profit, profit is equals to contribution minus fixed cost. It has another way to derive as it's shown in the chart. Sales minus variable cost, we get contribution, and contribution minus fixed cost, we get profit or loss. Next, we have a most important calculation part in marginal costing, which is PV ratio, BEP, and MOS. Let's see it one by one. PV ratio is nothing but profit volume ratio. It is a ratio of contribution to sales. If there is a high PV ratio, it indicates high profitability, and if there is a low PV ratio, it indicates low profitability. There is no need to mug this as a formula. As we know, contribution is a part of profit, and volumes are generally called as sales. And when there is a ratio asked, then we need to multiply it by 100, and thus we can derive it easily. Contribution divided by sales into 100. Next is about BEP, which is known as break-even point. In simple words, at the point where there is neither profit nor loss, then it is known as BEP. Break-even point can be either in units or in rupees. Next concept is about MOS, which is named as margin of safety. In simple words, whatever earnings are made beyond the BEP is called as margin of safety. Don't get confused with BEP and MOS. BEP is earning to the extent of fixed cost. MOS is earnings beyond the BEP. To make it easy, let's see an example in a graphical manner. In this example, units are given as 250, 500, 750, 1500, 1750. And the selling price per unit is rupees 20. So if you multiply with the units given, you get 5,000, 10,000, 15,000, 30,000, 35,000. As the selling price is calculated, similarly variable cost is also done, and fixed cost remains constant and fixed irrespective of output produced. And as we know, total cost is calculated by adding variable cost and fixed cost. So as we know the total cost now, to find whether profit or loss, we need to subtract total cost from selling price. Now we need to graph it, as the x-axis are quantity, which is units, and y-axis are the price. First we need to plot the units with the selling price and name that line as total revenue. And now we need to plot the units with the total cost and name that line as total cost. And now the intersecting point is the BEP, break-even point, where there is no profit and no loss. And the curve before the break-even point is loss, and the streamed wide curve is the profit margin. Here the range of profit is increasing because of the increase in angle. This acute angle is called as an angle of incidence. And I hope you are clear with this concept of marginal costing with all the examples given over here. And I hope you like this video, and it would have been more informative and useful video, and thanks for watching.